Trading is one of those things that sounds simple until it isn't. You watch the charts, you read a few articles, maybe you follow some people online who seem to always know where the market is going, and eventually you think, I can do this. Not because you're reckless, but because the whole thing genuinely looks learnable. And in the beginning, it actually feels like you are learning. A few trades go your way. The numbers go up. There's a rush that's hard to describe, something between pride and excitement, like you found a shortcut that most people don't know about. That feeling is the most dangerous thing in trading. Not the market, not the volatility, not even the leverage. That feeling. Because once it's there, it starts making decisions for you. The account didn't blow up overnight. That's the part people don't understand when they imagine what losing everything in trading looks like. They picture a single catastrophic moment, one bad trade, one red candle, and it's over. But the reality is slower and, in some ways, more brutal. It happens in layers. First, you lose a little and you tell yourself it's fine. It's part of the process. Every trader has drawdowns. Then you lose a little more and you start chasing, increasing position sizes to recover faster. Then a trade goes really wrong and you freeze, unable to close it because closing it means accepting the loss, and some part of you is convinced the market will come back. It doesn't. Not in time. And by the time the position finally closes, either by your hand or by the brokers, the damage is something you have to sit with in complete silence. The silence is the thing nobody prepares you for. There's a specific kind of shame that comes with losing money you couldn't afford to lose. It doesn't matter how it happened or why, the shame shows up regardless. You start doing calculations in your head at strange hours, lying awake at 2 in the morning, trying to figure out how to explain what happened. Whether you even need to explain it, how long you can delay explaining it. You replay trades in your mind with an almost obsessive precision, pointing to the exact moments where a different decision would have changed everything. You imagine alternate timelines, where you held that position one more day, or closed that trade 10 pips earlier, or simply never opened that account at all. The mind does this automatically, and it's exhausting. What made it worse was the isolation. Trading is a solitary activity by nature, and when things go wrong, the solitude that once felt like freedom starts to feel like a trap. There's no team to share the loss with, no manager to explain the situation to, no structure that forces a conversation. Just a person, a screen, and a number that keeps getting smaller. And the world outside keeps moving, people going to work, making plans, living ordinary lives, while inside there's this private catastrophe that nobody can see. The first instinct was to fix it. Not to stop, not to step back, but to fix it. To get back what was lost as quickly as possible. This is where a lot of traders make the situation significantly worse, because the emotional state that follows a major loss is precisely the worst state in which to make financial decisions. The mind isn't thinking clearly. It's operating from panic and urgency produce trades that are bigger, faster, and less thought out than anything that came before. One bad trade becomes the justification for another. The logic sounds reasonable in the moment, just one good trade, just get back to even, just stop the bleeding. But that logic is a trap. It has taken more money from more traders than any single market event in history. What eventually forced the stopping wasn't wisdom. It was exhaustion. There came a point where the mental and emotional weight of it became too heavy to carry another step forward. Not a dramatic breakdown. Just a quiet, heavy moment of sitting down and not being able to get back up. A kind of stillness that wasn't peaceful but was at least honest. And in that stillness, something shifted. Not a solution, not a plan, just a shift in perspective. From trying to fix the situation to actually looking at it clearly, without flinching, was harder than anything that had happened in the market. The money was gone. That was a fact. Some of it could be recovered over time through work, through discipline, through restructuring expenses. But the trading account itself was gone, and pretending otherwise was a form of dishonesty that had already cost too much. Accepting that fact, truly accepting it rather than just saying the words, took longer than expected. Acceptance isn't a moment, it's a process. It arrives in pieces, and sometimes it retreats before it returns. And the whole thing is uncomfortable in a way that can't be rushed. But on the other side of that acceptance was something genuinely useful: the ability to ask real questions instead of desperate ones. The real question wasn't how to recover the money. The real question was how this happened at all. That question, taken seriously, opened up something important. Because the answer wasn't bad luck. Bad luck exists in trading, of course it does, but bad luck alone doesn't cause the kind of loss that had happened. The answer was a series of decisions, patterns, and beliefs that had been operating underneath the surface for the entire time, largely invisible, influencing every trade without ever being examined. Things like the way risk was calculated, or rather, the way risk was quietly ignored when a trade felt right. Things like the relationship with loss itself, the inability to close a losing position because of what closing it would mean, emotionally, for how the whole thing was going. Things like the need to be right, which is different from the need to make money, and which leads to holding bad trades far too long, because exiting them feels like admitting failure. None of these were unique. That was one of the more startling realizations, that virtually every mistake that had been made was a documented, well-understood pattern that traders had been falling into for decades. The psychology of trading has been studied extensively, and the same cognitive traps show up again and again across different markets, different time periods, different types of traders. The overconfidence that follows early success. The loss aversion that makes a $10 loss feel worse than a $10 gain feels good. The sunk cost thinking that keeps a person in a losing position because of how much has already been lost rather than what's likely to happen next. The narrative fallacy, where the mind constructs a story about why a trade is going to work and then filters all incoming information through that story, ignoring anything that contradicts it. Understanding these patterns intellectually and actually changing them in practice are two completely different things. Reading about cognitive biases doesn't make you immune to them, any more than reading about gravity makes you able to fly. What it does, though, is create a small gap between the impulse and the action. A moment of recognition: this is the pattern, this is the bias operating right now, that can, over time and with deliberate effort, create space for a different choice. That gap is where recovery actually lives. The rebuilding didn't start with charts or strategies. It started with a very basic question about what trading was actually supposed to be. Not what it had become: a way to recover losses, a source of emotional intensity, an identity, but what it was supposed to be functionally, if it was going to be anything at all. The answer was straightforward: a method of generating returns from capital through a systematic, repeatable process with defined risk parameters. Not exciting. Not a game, not a place to prove anything, a process. And a process can be designed, tested, evaluated, and improved. A process can also be stopped when it's not working, without it meaning anything about who you are as a person. That reframing, from trading as identity to trading as process, was more significant than any strategy change. Because when trading is tied to identity, every loss is personal. Every losing trade is evidence of something. Every drawdown becomes a referendum on your intelligence, your worth, your judgment. And when stakes are that high emotionally, the brain does everything in its power to avoid the pain, which means avoiding the information the market is providing, holding losers too long, adding to bad positions, refusing to take stops. The market doesn't care about any of that. It keeps doing what it does. And the gap between what the market is doing and what the brain is willing to accept becomes the account balance, bleeding out in slow motion. When trading is process, a losing trade is data. Not pleasant data, but information about the market, about the strategy, about execution. It can be looked at without flinching because it isn't about you. A stop loss being hit isn't failure. It's the system working. The position was wrong. The system identified it and got out at a predetermined point. That's not a bad outcome. That's the process functioning correctly. The shift in how that feels emotionally is enormous. Risk management came next, and it came with a seriousness that had never been there before. Not the kind of risk management that gets nodded at in theory and then quietly abandoned when a trade feels strong, actual, rigid, non-negotiable risk management. Never risking more than a small, fixed percentage of the account on any single trade. Never adding to a losing position. never moving a stop loss further away from entry because the trade was going against you. These aren't complicated rules. Every book on trading mentions them. But there's a difference between knowing the rules and being the kind of person who keeps them when the market is moving fast and the conviction is high and every instinct is screaming that this is different. This time it's going to turn around. Building that discipline required building something that hadn't existed before, a trading journal that was honest. Not a record of entries and exits, though it included those. A record of the emotional state before each trade, the reasoning, the expectation, the outcome, and what the journal keeper actually felt when that outcome arrived. It sounds tedious, and it is in the beginning. But what it produces over time is a picture of yourself as a trader that no amount of chart analysis can provide. Patterns emerge. Not market patterns, personal patterns. The trades that were opened out of boredom versus the trades that had a genuine setup. The way position size crept up after a series of wins. The way the rules bent during periods of drawdown. The journal made these invisible forces visible, and visible forces can be addressed. The market itself had to be approached differently too. There had been, before everything fell apart, a kind of arrogance in the way the market was engaged with. Not conscious arrogance, but the kind that develops when a few early wins create the impression that you've figured something out. The market is not a puzzle to be solved. It is not a system that rewards intelligence or effort in any direct way. It is a vast, complex, constantly evolving environment that reflects the collective behavior of millions of participants, many of whom have access to more information, more computing power, more experience, and more capital than any individual retail trader. Humility in the face of that isn't weakness, it's accuracy. That humility changed how strategies were developed and evaluated. Instead of looking for the one method that was going to unlock consistent profits, the focus shifted to understanding what edge actually meant and whether a genuine edge existed in the approach being used. An edge in trading is simply a set of conditions under which your probability of a winning trade is marginally higher than losing. It doesn't mean you always win. It doesn't mean you win most of the time, necessarily. It means that over a large enough sample of trades, the math works in your favor, assuming the trades are executed according to the plan, risk is managed properly, and emotional interference is minimized. Testing strategies rigorously, over historical data and then in small real money conditions with realistic assumptions and without cherry-picking results, became the only way a strategy got any serious consideration. There were also some difficult realizations about what trading was supposed to provide that had nothing to do with money. There had been a need for the rush, the dopamine of a winning trade, the intensity of watching something in real time, the feeling of being in the action. That need didn't disappear when the account did. Understanding that it existed, and that it had been driving decisions that were framed as financial decisions, but were actually emotional ones, was uncomfortable. Because it meant looking honestly at why trading had been so compelling in the first place, and whether some of that compulsion had been serving needs that had nothing to do with building wealth. This isn't a comfortable thing to sit with, but sitting with it is part of recovery. Because if those needs aren't acknowledged, they don't disappear, they just keep showing up in the trading, wearing different disguises. The addiction to volatility disguised as conviction. The need for stimulation disguised as active management. The avoidance of boredom disguised as monitoring the market. Identifying these things honestly and without judgment creates the possibility of meeting those needs elsewhere, in exercise, in creative work, in real human connection, rather than roading them through a trading account where they will, reliably and repeatedly, cause damage. The path back to trading, because there was a path back, not for everyone but for those who choose it, was slow. Slower than felt necessary and slower than the urgency wanted. Starting with a very small amount of capital, smaller than felt meaningful, and treating it as tuition rather than investment. Accepting that the early period was about process, not profit, and that a month with no gains but consistent execution of the plan was a more successful month than one with a large gain achieved through a rules violation. That reordering of what success meant was essential. It sounds simple. Putting it into practice consistently over the emotional terrain of real trades with real money is one of the more challenging things a person can do. What saved things wasn't a strategy. It wasn't a mentor, wasn't a community, wasn't a book, though all of those things contributed something. What saved things was a willingness to be honest about what had happened, about why it had happened, about what role had been played in bringing it about, and about what needed to change for a different outcome to be possible. That kind of honesty is rare because it's painful. It requires sitting with the full weight of something that went very wrong without deflecting the blame outward, without hiding behind market conditions or bad luck, without minimizing the seriousness of the choices that were made. It requires looking at a version of yourself that you'd rather not see, and acknowledging that version clearly enough to actually change. There's also something worth saying about time. Recovery from a significant financial and emotional loss takes longer than the loss itself. The account can be rebuilt in months, in theory, but the internal rewiring that makes the rebuild sustainable takes years. And that's not a warning designed to discourage. It's an honest account of how change actually works. Behavior that took years to develop, reinforced by thousands of micro decisions and emotional experiences, doesn't transform overnight because the right framework has been found. It transforms slowly, through repeated practice, through experiencing the results of the new approach over time, through gradually building the kind of track record with yourself that makes the new patterns feel natural rather than effortful. There are people who lose everything in trading and never come back. Some because the damage is too severe and the circumstances too difficult. Some because the lesson doesn't register and the same patterns repeat until there's nothing left. Some because they decide, correctly, that trading isn't worth it, that the time, the stress, the capital requirements, and the psychological toll don't justify whatever returns might eventually be possible, and that there are better uses of all of those resources. That's a completely legitimate conclusion. Trading is not for everyone. The market doesn't care who participates and rewards no particular class of person simply for being present in it. But some people come back, and they come back differently. Not with more confidence, with more clarity. Not with certainty about what the market is going to do, but with certainty about what they are going to do when it does different things. That's the only control that actually exists in trading, and the only control that actually matters. Everything else is the market doing what it wants. The edge lives in the response, in the quality of the decision making under pressure, in the consistency of execution when it's uncomfortable, in the discipline of sitting on the hands when the setup isn't there, in the willingness to be wrong quickly and cheaply so that being right eventually means something. Losing everything in trading is a terrible experience. There's no version of it that isn't. But it can also be a clarifying one, the kind of forced examination that ordinary success never produces. When there's nothing left to protect, there's also nothing left to pretend. And sometimes that's exactly the condition that makes real growth possible. Not because the loss was good or necessary or somehow deserved, but because what comes after it, if a person is willing to do the work, can be something that the person before the loss never could have built. Because the person before the loss didn't yet know what they didn't know. That's what saved things in the end. Not a trade, not a market recovery, not luck, the willingness to look at the wreckage honestly and ask, without flinching, what it was actually made of. Traders must be willing to question what they hear, test what they learn, and accept that simplicity can sometimes hide important complexity. By doing so, they move away from belief-based decision-making and toward a more structured, evidence-based approach. This transition is not always easy, but it is necessary for developing a realistic understanding of the market and achieving long-term consistency. Breaking down common trading myths is essential because many of them sound logical on the surface, yet quietly distort how traders make decisions. These beliefs often persist not because they are entirely wrong, but because they contain partial truths that are misunderstood or applied without context. By examining them closely, it becomes easier to replace assumption-based thinking with a more realistic and effective approach. One of the most widespread myths is that using more indicators leads to better accuracy. At first glance, this seems reasonable, More tools should mean more confirmation, and therefore better decisions. However, in practice, adding multiple indicators often creates more problems than it solves. Many indicators are derived from the same price data, which means they tend to provide similar or lagging information. There are periods of strong trends, periods of consolidation, and periods of unpredictable volatility. A strategy that performs well in one environment may struggle in another. For example, a trend-following strategy may generate consistent profits during trending markets, but experience frequent losses during ranging conditions. By testing across various scenarios, traders can identify when a strategy is most effective and when it should be avoided or adjusted. Ultimately, the goal of testing is not to find a perfect strategy because one does not exist. Instead, the objective is to develop a deep understanding of how a strategy behaves. This includes knowing its strengths, its limitations, and the conditions in which it performs best. With this understanding, traders can make informed decisions, set realistic expectations, and apply their strategies with greater confidence. When trading beliefs are tested systematically, myths begin to lose their influence. Decisions are no longer based on what sounds convincing, but on what has been proven through consistent evaluation. This shift transforms trading into a structured, evidence-based process where clarity replaces uncertainty and discipline replaces guesswork. Replacing trading myths with structured principles is where real transformation begins. Once beliefs have been tested and their limitations exposed, the next step is to build a framework that is grounded in evidence and consistency. Unlike myths, which rely on assumptions and generalizations, principles are practical, repeatable, and adaptable. They guide decision-making in a way that remains stable even as market conditions change. One of the most important principles is simplicity. In trading, complexity often creates the illusion of control, but in reality, it increases the likelihood of error. Strategies that rely on too many conditions, indicators, or exceptions become difficult to follow consistently. This leads to hesitation, second-guessing, and inconsistent execution. A simple strategy, on the other hand, is clear and easy to apply. It allows traders to focus on execution rather than interpretation. Simplicity does not mean lack of depth. It means removing unnecessary elements so that the core logic of the strategy can function effectively without confusion. Risk management is another foundational principle that replaces several common myths. Instead of focusing on how much can be gained from a trade, the priority shifts to how much can be lost. Controlling risk on each trade ensures that no single decision has the power to significantly damage the account. This creates stability, which is essential for long-term success. A trader with strong risk management can withstand losing streaks and continue operating, while one who ignores risk may experience rapid drawdowns even with a seemingly good strategy. Over time, consistent risk control matters far more than achieving a high win rate. Closely related to this is probability-based thinking. Trading is not about predicting exact outcomes. It is about operating within a system that has a statistical edge. Each trade is just one event in a larger sequence, and its individual result is less important than the overall performance across many trades. This mindset reduces emotional pressure and helps traders stay consistent. Instead of reacting to wins and losses, they focus on executing their strategy repeatedly under the same conditions. Over time, if the edge is valid, the results begin to reflect it. Selectivity is another principle that directly counters the myth that more activity leads to better results. Taking fewer, high-quality trades improves overall performance by reducing unnecessary exposure. Not every market movement is an opportunity, and recognizing this is a sign of maturity in trading. Patience becomes a competitive advantage. By waiting for setups that meet clear criteria, traders increase the probability of success while minimizing noise and randomness. This disciplined approach leads to more consistent outcomes compared to constant, reactive trading. Discipline ties all these principles together. Without discipline, even the best strategy will fail. It is not enough to know what to do. Execution must be consistent. This means following predefined rules regardless of recent outcomes. After a loss, there may be a temptation to adjust the strategy impulsively. After a win, there may be a tendency to become overconfident. Discipline prevents these reactions from influencing decisions. It ensures that actions remain aligned with the plan, creating stability over time. Consistency in behavior is what ultimately produces consistency in results. Adaptability is the final piece of the framework. While discipline requires sticking to a plan, adaptability ensures that the plan itself remains relevant. Markets evolve, and strategies that once performed well may become less effective under new conditions. However, adjustments should not be based on emotions or short-term outcomes. They should be driven by data and careful analysis. By periodically reviewing performance and identifying patterns, traders can make informed changes that improve their strategy without compromising its structure. Together, these principles form a practical and reliable approach to trading. Simplicity ensures clarity, risk management provides protection, probability-based thinking creates realistic expectations, selectivity improves trade quality, discipline maintains consistency, and adaptability keeps the strategy aligned with changing conditions. Unlike myths, which offer quick answers but lead to long-term confusion, these principles require effort and patience, but they deliver sustainable results. Ultimately, this shift replaces belief with understanding. Trading decisions are no longer based on what sounds convincing, but on what has been proven through structured thinking and consistent execution. This is what allows traders to move from uncertainty and inconsistency toward control, clarity, and long-term stability. Building a reliable trading approach in 2026 is not about discovering a secret strategy or predicting the market with precision. It is about integrating tested principles into a structured and repeatable system. After moving beyond myths and validating ideas through data, the final step is combining everything into a cohesive approach that aligns strategy, risk management, and execution. This integration is what transforms trading from a series of random decisions into a controlled and consistent process. A reliable approach always begins with a clearly defined strategy.